Well, good day to all that are able to join us and those who will be watching this through the YouTube channel. As I've shared with Scott and Mike Gardner, the series has increasingly found its footing in the realization that we are now having over 300 individuals download and or watch the video on YouTube. So thank you for those who have joined us quote unquote live and those who will be listening. I'm Richard Seeline, co-founder of the Resilience Innovation Hub based out of Houston, but obviously a national network of peer organizations and strategic partners. For those of you who have joined us for the previous series, apologies, but I'm going to go through some of the background on what got us here and what our focus is. And for those of you who are joining for the first time, this will be a little bit of a quick intro. When we went from the 2-day in-person 250 participant forum to a virtual setting, the objectives haven't changed. Our goals remain where we are trying to bring the best minds across financing, equipment, technology, data science, insurance and non-insurance representatives, inventors, innovators, all together to ultimately figure out how, one, you all can connect more efficiently and effectively, but most importantly, to actually drive the impact of new investments around climate sustainability in this general theme of pre-disaster and risk mitigated resilience. So I think we've achieved that. This is our 10th in the series. We have 2 more lined up, which I'll talk about in a little bit. But I think we are achieving the goal that we sought. As you all are also aware, not just in the United States, but globally, there have been a number of disasters that have served as drivers for the forum. We've gone from a handful of billion-dollar wet weather or weather-related events to now back-to-back and sometimes literally simultaneous sets of events, including COVID and related to the pandemic impact on facilities and operations. So the realization that we are in a somewhat permanent state, Scott and Mike, of back-to-back persistent disasters where communities and companies and industries are at the same time planning for, responding to, and recovering, rebuilding from these types of events is somewhat now the norm. We also know that there's a lot of discussion, and that's what part of today is about in regards to these resource drivers, whether they're federal, state, local, insurance, non-insurance resources. And when I talk about resources here, we're not talking just about money. We're talking about the intellectual capacity of new knowledge, new types of innovations, new ways of doing business. And Scott, I think you'll cover a little bit about how some of the ratings are driving that. And Mike will talk about where some of the new types of public-private philanthropic partnerships are emerging. But there's a lot of thinking that's underway. We now know that there are abundant resources available in this area of resilience. And some of you have seen this before and heard me say this, but it is worth reminding ourselves each time. The resources are not the question. They're fragmented, they're disjointed, sometimes difficult to find, sometimes difficult to create a financial stack. And Michael, hopefully you'll cover a little bit about kind of this idea of the financial stacks. But we're not without resources, whether it's public sector, private sector, and increasingly the philanthropic sector, like we heard from Howard Buffett and Brad Doxer earlier in the forum series. $1.26 trillion, Scott, of potential resources coming from the reinsurance sector, as the Reinsurance Association of America announced last July. $550 billion plus of unused presidential declaration funds that are still tied up in many state and local treasuries unspent. And then you've got this $12 trillion of generational wealth, social impact, family offices. So one more time, it's not the capital, it's how we actually organize capital, how we look at its performance, what's driving the use of that financing. And I want to tie this in. I found this over the past couple of days in reading some additional reports and studies that have come out. One recently from our friends at the Brookings Institution, and we hope to have Joseph Kane and his colleagues participate in one of our next forums. But you can see, without my emphasizing, there's a lot of work being done right now about this climate resilient infrastructure, and especially how you scale these large projects. But it also is tying projects not just, Scott, to the traditional returns on investments and cost benefit, which is what we've talked about previously. It's also, how do we take a look at these additional cost benefit offsets? Some of them are financial, some of them are societal, some of them are impacting low to moderate income communities. But it's also the operational side. So it's not just the physical facility, it's the operational side. I know we've talked about many pieces of this, but I'm looking forward to today's session with my good friend Scott, and I'll have Scott introduce himself first, give it a little bit of his background, and then my partner in crime and professor on public-private partnerships and digitizing these types of project financing, Michael Gardner with Aqaix. So Scott and Michael, I really appreciate y'all taking time to do this, and I'm looking forward to a robust conversation. Scott, why don't you unmute yourself? Michael, you can do the same as well, and we'll jump into both your presentations and the fireside.
Sure. Thanks, Richard. Thanks for the introduction. Let me go ahead and share my screen. Okay. All right. Everybody can see that? Perfect. All right. Well, thank you for having me here. I go back a long way with Richard. Believe it or not, he was one of my first managers that I ever had 20 plus years ago, and we're still talking. So it's always great to participate in something Richard's organized. So as Richard mentioned, I'm the global head of infrastructure and project finance here at FITCH Ratings. And what I thought I'd do would just give a little background on what we do at FITCH, how it relates to the infrastructure space, and how we're looking at incorporating that into our ratings. And then I know we're going to get into a QA session here shortly. But just a broad background where FITCH Ratings sits. We're owned by the Hearst Corporation. I sit over on the left-hand side in FITCH Ratings. And what we're doing is providing credit insight to investors as they're buying different debt instruments, be they a bond investor, pension fund, sovereign wealth fund, what have you, globally that's investing in debt instruments. And you can see some of the other parts of FITCH worth mentioning. Here are again, one I'll point out, and I can get into a little bit in my comments if you look all the way up. On the right-hand side, FITCH recently set up a sustainable FITCH to look at some of these ESG factors specifically as it relates to a rating separate and apart from a credit rating, which I'll get into here. So just to provide a baseline for everybody so that we're talking at the same level, on what a credit rating is. What we're asked to do as an agency is to provide independent assessment on a borrower's ability to repay debt on a timely principal and interest payment schedule. So we're assessing the relative risk of the borrower to be able to repay the obligation. Some have probably heard the terms that it comes at the top of the stack is the AAA level, on down AA, single A, triple B. That's what we consider the investment grade spot. And then once you get below investment grade, that's non-investment grade or junk bond, speculative. We see the gamut here on the team globally. What we do is we provide a rating upfront when the debt is being issued, and then our obligation continues while the debt remains outstanding, and we have a regular monitoring of that and assessing the ability. But I wanted to give that as a general background before we get into some of the more detailed discussions, just so you can see the perspective that I'm coming at it from. One thing to caveat is we're not making buy or sell recommendations. We don't get into policy. What we rate is affected by policy, but we look at it simply on the merits of the credit obligation and the ability to repay. Don't get into politics in terms of from a policy perspective. We don't talk about how a matter should necessarily be handled. We're really evaluating the projects themselves and their ability to repay debt. So when we think about infrastructure from a Fitch perspective, it runs the gamut. And you can see here we have a global team. So I sit above 75 analysts spread throughout the world. We have broken down into 4 regions: North America, Latin America, Asia Pacific, and then Europe and the Middle East as one. And it runs the gamut on the types of projects that we're looking to evaluate. On the energy side, from a standalone project financing basis, that portfolio is comprised of a lot of LNG, liquefied natural gas, as well as we're seeing an increase globally as we switch to renewable and green energy. And that's something that we look at. Then throughout the world, it runs a spectrum on here, just looking at the bottom of the slide, quite a bit in the water space globally. One of the areas that we're also seeing an increased interest, some of it related to the pandemic, would be in telecommunications and the concept of digital infrastructure. What we see here, and then different parts of the world, they do hospitals and schools on a project finance basis that we'll evaluate, and then getting into stadiums and arenas that we have an opportunity, all of us in our personal lives, to go visit and see. We look at that from a credit standpoint, and then really the hallmark of the group is a lot of transportation. And transportation is evolving, but it's a lot of airports, seaports, toll roads, rail that we see again as a project finance. And when I say project finance, that's not backed by tax revenues. It's not got some kind of corporate guarantee sitting over it. It's the ability of the project to make timely principal and interest payments on the debt on a standalone basis. Just real quickly, what I thought I'd talk about would be how we use some of the risk factors, because I think this will feed into some of the items that I know Richard's gonna ask about, and we're gonna talk about. But how we go about evaluating these huge hundreds of millions of dollar projects, in some instances, in the case of billions of dollar projects, we really break them down into key risk factors. First, foremost, project's got to be completed. It's got to be completed on time, on budget, to the specs of how it was originally designed. That's a key piece of it. Then there's also the revenue component. And the revenue component could be, if we're talking about a toll road, it's the number of cars or vehicles showing up, paying the toll to ride on the roadway, or if it's through employments at an airport and looking at what's going on with the airline use and lease agreements, or what's going on from a retail perspective. The other pieces of it focus on cost items and what can be done to control costs as they're operating an asset. And I think one of the key points, and when we get into more of the discussion on resiliency, is this area of infrastructure development and renewal. So we're looking at a project, typically what we'll see is something that's going out 20 or 30 years time. And we want to make sure that that asset is in a condition or state of good repair throughout the life of the debt being outstanding, so that it has an ability to operate and then generate the revenues to repay the debt. So infrastructure renewal and development are a big piece of what we're doing. And that's why when Richard had asked if I could join this, that's why I was so interested in it. And then there's the debt structure piece, not to be diminished, but there you're really looking at getting into what features of the debt structure pose risks to the project, whether you're talking about some type of a refinancing, a balloon payment, some type of a variable rate debt where you're susceptible to changes in interest rates that would have an impact. And then we have a portfolio of 600 plus credits around the globe. So a peer analysis is a big part of what we're looking at to understand how we've rated an airport in Europe, consistent with Latin America, Asia, all part of the analysis. And then cash flow analysis, when we look at our revenue forecasts and our views of what the operating costs are and what the ongoing infrastructure development needs are going to be, that is put into a cash flow model that we evaluate to understand if it has the correct metrics, be it a leverage metric or some type of a debt service coverage ratio, in order to sustain and repay the debt. But I wanted to provide that as just an overview. I know we're going to get into more detail, and I'll just skip to my last slide here. A key part of what we're doing increasingly centers around ESG, environmental, social, and governance. So every deal in our portfolio, our rated credit portfolio, comes with an ESG relevance score. And what that is looking at the factors that make up E, S, and G, assigning how much impact that has to the overall rating. So for example, if we were to rate a toll road at the A level, an A credit rating, how do ESG factors play into that? At 5 at the top end of the spectrum, it's very highly relevant to what we're doing. And then at the low spectrum, the inverse of that, where it's irrelevant. What we tend to find in the infrastructure space is around the 2 to 3. If you were to take an average of the portfolio, that's where it would fall. There would be some relevance, but not always a lot. There are cases, there could be something on a governance side or an environmental side that has a high impact, and we can certainly talk about those examples. But I just want to give you a context of how it's increasingly important to us. And I can't think of the last time I was either had an investor meeting or an issuer meeting where the subject of ESG and environmental resiliency didn't come up. So it's certainly top of mind to the market. But I'll pause my prepared remarks there and turn it over to Michael.
And I want to come back, Scott, to this slide. So kind of keep it hot on your side when after Mike does his, because I may ask you to pull it back up.
Sure.
Okay. Michael?
Great. Thanks, Richard. So, my PowerPoint just crashed. So let me start. Sorry about that. Let me restart screen sharing. I don't know what happened, but when I started sharing, PowerPoint crashed. So let's see if we can do this again. And that was after we tested it. How's that?
Perfect.
Okay.
Why don't you just keep it on that, and that way it'll.
Yeah, I'm not going to risk anything.
Yeah. Perfect.
So, hi, I'm Mike Gardner. I'm a co-founder and the CEO of Aqaix. We are a software company that has a platform for, it's a fintech platform for resilience finance, and specifically it's for project finance. And we automate the various business processes of financing resilience infrastructure. I'm not going to get too much into the details, but any of you who are familiar with project finance and so forth know that there's a lot of relatively tedious kinds of business processes that are highly paper intensive today. So everything from sourcing opportunities and evaluating them, screening and filtering through to due diligence, getting into the actual transaction and all the paperwork entailed with that. And then finally, getting into portfolio management. Every single one of those phases is highly paper intensive today, and bears software automation, and that's what we're doing, is providing software for that. So a private equity firm that is investing in resilience infrastructure projects, or a bank or any other type of investor that wants to be able to do this kind of investing, uses our software. There are some other examples of how it can be used, and I'll show an example of that in a minute. I want to mention that we started in water, but since then we've diversified to all types of resilience project types, including energy, including flood mitigation, including sea rise mitigation, things like that. So we cover a broad spectrum of types of projects, but we have not forgotten our water roots. And I just want to say Happy World Water Day to everyone. This year's theme is groundwater, so take a minute and think about the groundwater that is part of your daily water usage and water benefits, basically. Getting back to Aqaix and getting back to resilience finance, in the series so far, some of the other presenters and some of the other sessions have talked about the types of capital that are available to bring to bear. And so Richard showed how much financial capital is available. I mean, trillions of dollars are available, but there's actually a lot of other types of capital that we have to be aware of and try to bring to bear in the financing structures and in the financing processes. So social capital is an example of a different type of capital. Information capital is also a key type of capital. And we actually deconstruct information capital down into data capital, the raw data. And some organizations have tons and tons of raw data. They have it in databases everywhere, but they don't really know what to do with it. And they're not actually converting it to get value out of it. There's actually no ROI from the data itself. In fact, at that stage, it's basically a cost. And increasingly, because of our data technologies today, increasingly we have more and more data that's in this state of its data capital. So it's a resource, for sure, it's valuable, but it's not really being used to deliver knowledge of what to do. It's not actionable until you essentially refine it into information. And at that point, you have ROI from it. And so forth. Then really, if you think about what FITCH Ratings does, that's what they do. They take information, they take data, and they are refining it into actionable insights into, is this a quality investment or not? And we're not an analytics company, Aqaix. We don't actually produce analytics like that or produce these insights like that. But we are able to use that data and use those insights in the software to both automate the processes of finance, but also to get all kinds of other things, reducing transaction costs, getting to better decision outcomes, being able to monitor the investments, and trust and transparency, and so forth. Another really key thing about using information capital and using knowledge capital is that, and this is going back to something that the last session, Francis Bouchard at Marsh & McLennan had said, basically, he said, look, the days of unilateral financing are over, basically. And I think increasingly when we look at these resilience projects, we see that is indeed true. And what we really have to think about is, how do you drive the collaboration of different types of investors and allow them to work together? And that becomes a key value from knowledge capital, basically, because it is what allows that collaboration, and it is what allows these new financing structures to operate. And we think of our mission at Aqaix as transforming resilience finance. And here's a simple way to think about it. If you look at traditional financial models and you look at accounting, they were very oriented towards one project and to one benefit, namely just financial ROI. Am I going to make money, and how much money am I going to make? If you look at what's happening with digital processes, you have the ability to be able to span across multi-project portfolios and understand those portfolios and understand, phase by phase and project by project. But at the sum total level, you can add it all up and you can go, this is what we're going to get in, say, the Houston area, this large mega city, basically, with very, very complex in terms of the social economic situation. But you can think at the portfolio scale with today's digital technology, and you can also think multi-benefit, and you can also think in terms of impact, not just financial return, but also impact return. Those ESG returns that Scott was talking about. If you look at information capital, it's basically being able to operate at the knowledge capital state rather than the data capital. If you think about financial capital itself, one of the types of capital, traditionally financial capital is competitive. One single funder wants to get that project and do the funding and make the money off it, and they basically don't want to share. If you think about the future, it's increasingly collaborative. It's what Francis Bouchard had said. The days of single funders are over. So we have to think in terms of how do we create collaborative funding? How do we have multiple funders able to cooperate? And then if you think about scale, instead of thinking about it and working at the single project scale, you can think about it at the portfolio scale. But another key aspect of that is you're thinking about it in terms of, say, the watershed, and the portfolio of projects is basically representing all the different projects of all types, green and gray, big and small, that have to be invested in to be able to achieve a water balance. And the same thing is true of the airshed and so forth. And so, being able to do context alignment of the environmental framework or the environmental system with the financial structures is a really key dimension of all this. I'm just going to quickly mention two examples of how to bring this to bear. So this example is based on Aqaix software, and we have a few customers that are using our software not in the classic way where a private equity firm or a bank would use it for their own usage to manage their investments, but rather you can create a marketplace, if you will, for finance where you can allow the collaboration across dozens or even hundreds of different entities that are needing to collectively run an investment process into a large metropolitan area or for a given watershed. And our software can help coordinate the capital across different funder types by the different phases of project. So this is one example, is running kind of a marketplace for finance, and it's one example of the principles that I've been talking about. I'm just going to end by showing you one other example, and this has nothing to do with Aqaix, just to mention that, but there's a pretty interesting group out here in California called Blue Forest Conservation. They're really instrumental in kind of taking P3s to the next level. And historically, P3s have been sort of one private party working with one public entity, basically. So it's kind of a one-to-one structure. Also, P3s have evolved to be kind of usually they incorporate some dimension of performance-based contracting. And so the private entity is on the hook to get to something. Usually they're motivated because their profitability is going to be dependent upon their performance. So they have that motivation. When you go to multi-party P3s, it gets more complex because the stakeholders have different incentives, and you have to structure the financing in a way to ensure that they're all incentivized to deliver the outcomes they want. But you also have to make sure that the measurement capability is there to measure those outcomes. And here's where the data comes back, and that knowledge capital, and employing that in the actual financial structures in performance-based contracts. And so what Blue Forest specializes in is going into a situation, identifying all the different stakeholders and the flows of benefits that are in that situation, quantifying the stakeholder value, and then using that to define a financial structure, a bond or a loan that is going to be repaid from the chain of benefits realization. So it does get repaid. It's project finance. It's getting repaid from the projects and from the returns on the projects, but it's a much more complicated flow than we've seen traditionally. And the best example of this is a case on one of the rivers in the Sierra Nevada here in California, the North Yuba. There's a few different problems, but the really major problem is wildfire risk in the mountain communities. California has been plagued by these really horrible wildfires over the last few years, basically, that have wiped out entire communities, just wiped them to the ground and so forth. The Yuba watershed is definitely at risk. Meanwhile, though, there's an opportunity downstream for hydroelectricity generation that would be used and purchased by Sacramento's utility, which is about 50 miles away, say, something like that. And so Blue Forest went in. I'm not going to go through every last detail here, but they went in, did the math, and said, look, if we can do the forestry upstream, we're going to reduce the wildfire risk, and that's going to reduce claims to the insurance companies. We're also going to be able to improve the electricity generation because it's more efficient. There's less debris, wood debris going down at high water that's going to clog up the intake systems into the hydro and so forth. And so in the end, they put together a first generation solution, which is in the middle now of actually processing 7,000 acres of forest treatment. It was invested in by the Automobile Insurance Association and by Calvert. There's various parties involved with a service contract. So this is this kind of classic multi-party situation with one single financial structure tying them all together. The first bond that was done here was only $4 million, relatively small. It was very prototypical, but the next phase that they're working on now is actually much larger. It's a $25 million version of the same thing. And so, this is, I think, the model that we're going to see everywhere around the country over the next, say, 5 to 10 years, where we're going to be able to employ data, we're going to be able to use it in performance-based contracts, and we're going to be able to allow collaboration across multiple funders. And thanks.
Fantastic. Mike, if you will take your slides down, but keep number 3 kind of hot. I want to come back to your number 3.
Okay.
In a part of the conversation, but let me throw a couple of questions as we welcome attendees to put their questions and ideas in the chat section. But Scott, I want to. There's a method in my madness. All right, so. I'm going to kind of go back and forth. At one end is the ability to have ratings directly or indirectly transform behavior. Now, as you said right up front, because I want to make sure I'm reiterating this, Fitch is not making a decision. It is a tool for decision makers to then take that information. But the large comma, however, is that ratings do have an influence now on behavior, all right? And so one of the things I started looking at a couple of questions I have, and I want to kind of connect the dots. So pull the slide back up that we mentioned.
That one?
Yes, sir. Okay. So, Scott, a couple of things come to mind. I just kind of want to use this as a visual reference. All right. As you all integrate ESG into the scoring, right? I sense that what I want to do as a project developer, project investor, is I want to find in my design, construction, engineering, implementation, I want to find ways that I am going to increase the likelihood of a higher rating. How do I do that?
Good question. We're focused on, and I think, kind of going into what you're saying, one of the areas is the longer term resiliency of the project. So right. We see projects, typically debt structure 20, 30 years. One of the things we need to understand is as the environment around us changes, you kind of look at it two-dimensional. One is, let's just take a toll road just because I think it's a simpler example.
Right.
You have 100-year storms happening more frequently. So there's an impact on the asset. So is the asset built to withstand a 100-year storm happening more frequently? What is the operating plan that in the CapEx plan that make that project available, that it's serviceable throughout the life of the debt, knowing that it's, in my example, is going to get pounded with a storm more frequently. Let's say it's on the sea level and it's going to deal with sea level rise. So there's the asset perspective. and understanding the engineering behind it so that it can withstand that. And on the flip side, we also have a revenue component. Remember I talked about the cash flows. So part of it is understanding if we have a toll road that's in an area that's hit so frequently by storms, what is going on in that market, or why are people, for lack of a better question, why are people still living there? What is the business case of why they're there? What other, beyond my asset, what other resiliency measures are going on that make people still want to live in that?
And I think Scott, that's kind of where I was headed to, is this is a combination of me future-proofing the design of new infrastructure and retrofitting infrastructure that may go back out for refinancing. So there's the asset itself and what the community is doing to future-proof not only around that asset, but also as a whole. And then the second thing is kind of this business continuity operational side, right? Because let's be blunt, if I can only create revenue 3 weeks out of the year, I've got 1 week of capital that is at risk.
Yeah.
So am I saying that that's how this begins to influence, and where these scores, these rankings begin to say to the engineer, the design, the developer, the government, public-private partnership, is that if you're looking at getting to a higher rating, these are the things that are recognized in our assessment. Now, again, neutrality of the rating, but I think what I'm looking at is the significant impact of what Fitch is doing here is signaling to the infrastructure, the development marketplace, that we are going to be looking at these other influences, and we hope like hell you are too. Am I saying that kind of?
Yeah, you're saying that in your way, Richard. Yeah, that's what we're getting at, is we're identifying those areas that have the greatest influence by these, up at the 4 and the 5 end of the spectrum. And we would anticipate that, with something as elevated in that sense, that it has a more of a direct influence on the rating. The other piece of it is, as we look and we do our cash flows out, understanding, taking things like environmental risk into consideration of projecting out cash flows, building that into our cases. We develop a base case and a rating case. The idea is that the project can withstand that and still meet debt. So taking those factors into consideration helps us in the evaluation. And I expect we're only going to be doing that more and more frequently.
So let me connect that to something that Michael is touching on as well. All right. Whether it's a toll road, a hospital, whatever the infrastructure is, first and foremost, there's got to be somebody and somehow that the bonds or whatever the financing are going to get paid back. Check mark, we all kind of, that's the simple underpinning. All right. But now when you have these projects that have multiple financing, multiple funders, some of what I would refer to as alternative revenue generation, Scott. So, toll road, I got a fee, you pay the fee to go across the toll road, all right? But I think one of the things that we've heard over the past 9 sessions of the forum is that there are other funders and other means of quote unquote generating revenue. And one of those quote unquote generating revenue may not be directly, Scott, in the direct line of the financing. It may be that it offsets something else. I offset future losses. I offset something. So I want to connect that, Scott, to where you think ratings may be in looking at these other revenues and other offsets. And then Mike, have you talk about exactly that project, that blue conservation moved to. So Scott, am I making sense of where this begins to have an influence or drawing out other types of revenue generation and offsets? And then Mike, talk a little bit about how you see that coming into the projects.
So just a lot of what we're seeing in infrastructure now is beyond the traditional. When people think of infrastructure, they tend to think of airports, seaports, some type of a power plant. What we're seeing, we call it alternative infrastructure assets, where it might have a linkage to a traditional infrastructure asset, but have a different revenue stream. An example I would give would be last year we rated New York State Thruway, the service areas. So we didn't rate the toll road where people get on at one exit in Albany, get off in Syracuse. What we rated was the service areas. It was done as a P3 concession. I look at that as a different type of infrastructure asset, still anchored in infrastructure because it's the revenue is directly tied to the traffic on the New York State Thruway, but it's a different form. And I would think that we're going to see more and more of those types of infrastructure assets as the definition globally of what infrastructure is evolves and expands. I just use that as one example.
Right. Mike, when you talk about these multiple funders and looking at, achieving not just potentially a higher Fitch rating, but also performance, because we're not just looking at Scott, hopefully I'm also saying this right. You're giving me a snapshot in time. However, what we're also looking at is the performance of that asset and what's occurring around that asset over a period of time. So Mike, when you think about these multiple funders and multiple revenue sources, tell me how you think that's playing out at this point or will begin to play out.
Well, if you look at here, maybe I'll share my screen and we can take a look at the we'll take a look at that blue forest bond, just as an example, basically. So, the science behind this in the forestry is that if you reduce the fuel, there's standards in forestry to say, look, we're going to take all the limbs on the trees, from the ground up to, and there's different heights that you would pick, 10 feet, 12 feet, 6 feet, whatever. But you basically go in and every single tree that's of a certain girth, a certain size, you remove all the limbs to remove the ladder fuels, basically. And then you also take out ground debris, you take out bushes, you take out the small trees. It's very selective. So a forester goes through and, they take into account like endangered species. So if there's an endangered oak tree, they'll leave that. They'll make sure that it has the right habitat. If there are bird considerations, to make sure that the bird population has adequate. They take all that into consideration. But at the end, there's well measured correlation between the type and style of fuel reduction and the volume of fuel reduction relative to the fire risk, basically, right? So in the performance contract part of this, the operator, in this case, they contract with the fundee is the National Forest Foundation that took the financing and then disperses it to operators that are actually going to do the forestry work. And they go through, but it's all very, very measurable from their field reports and through subsequent site inspections. Also, there's periodic inspections. Also, it's worth noting there has to be maintenance on that forestry work. And this is thinking of the forest as an asset and and so forth, right? And in a way, it's the maintenance, the forestry work itself in a certain way is a type of infrastructure asset, but the forest is really what the asset is. It's an environmental resource, and but you have to invest in it, and this is kind of like an operations and maintenance cost on that. But in the end, that reduces the fire risk, and you can measure that. Now, That's not to say that there won't be a fire. That could happen, but statistically, the probability is very reduced of it having the catastrophic damage and having the spread, and therefore driving the astronomical claims that are basically either driving insurance companies in California out of the fire coverage business entirely, or causing them to go bankrupt, or causing them to raise rates to the point where landowners just can't afford them, basically, and so forth. So we're right on the brink of a very untenable situation, basically. But it is possible to measure all that and use data to be able to make the decisions, and then also measure, did the operator get to the point that we expected in terms of the reduced fuel load, basically. So it's a very measurable outcome that lends itself perfectly to a pay for performance type financing structure.
So again, let me play off of what you just said. Scott, you're not going to remember this. I can't remember what I had for breakfast this morning, but somehow I remember things from 20 years ago. But when you and I worked together way back, one of the projects that I got assigned was to take a look at the New York, New Jersey, Connecticut transit. They were going to do a multi-state transit infrastructure project. And one of the questions I asked them was about how much right-of-way they had. And they actually had almost 40% excess capacity on the right-of-way. And I asked kind of a stupid question, well, why are you not putting fiber optics in that? Well, that kind of began to ring something that you said and Mike said, is a lot of the assets that we're looking at, and when it comes to resilience, whether it's sustainability, climate, smart infrastructure, I think what we're now seeing is this multiple layer use of assets. And just a couple of days ago, there were a series of articles about how much rooftop space is now under leveraged for solar. Okay, you would think, okay, come on, why hadn't anybody figured that out? Well, now you've got the big box retailers and the big distribution centers realizing that they cannot rely solely on the localized energy power supply, right? So I think both of y'all are saying the same thing here, is that assets for resilience can be measured in lots of additional ways to get maximum benefit, frankly, from revenue generation, but also maximum benefit from ways that it can impact reduction of risk. And those risks, I think, are the ones that we are really been honing in on, whether it's, flood and drought, fires, snow and ice. Am I making sense, guys, that yeah, we're now in this really interesting new way of looking at assets and looking at risk?
Yeah, I think this Blue Forest case is sort of a chain of a flow of benefits. It go, this stakeholder gets this, and then that's going to be, that can be transferred to this. It kind of cascades through. But another way to think about it is being able to stack up the benefits, or stack those basically, and say, a good example would be, say, you are going to do an infrastructure project that's going to sequester carbon. Well, that same project, and so you can originate carbon credits that can be monetized. That same infrastructure may be able to originate biodiversity credits. That same infrastructure may be able to reduce water pollution and originate water quality credits, or water volumetric credits, basically, which are really hot right now because of data center water usage and so forth. So you can also think in terms of stacking up those benefits. That stack, essentially, this is a frontier. This needs to be done. It's not like this is being done regularly, but that stack can be securitized essentially, and then that becomes an asset that investors can invest in, is to secure this pool of securitized assets across a set of stacked benefits. And that is one of the things that you can accomplish if you have one of these finance marketplaces. But that's going to get into I don't think we have time to really delve into that too much.
No. But I think, Scott, my question, and it really is somewhat of a rhetorical question, whether it's Fitch or any of the ESG metrics that we're looking at in the marketplace, all right, is this capital stack, and Mike, you took it right where I wanted you to take it. We got this capital stack that's basically saying, Scott, I'm gonna guarantee to the best degree of paying back, check mark now, I got your items around the circle, all right? But now we've got these benefit stacks that we probably have not truly recognized historically. And frankly, we now have these drivers that are almost demanding more benefits. So is that where you see Fitch looking again, not just at the ESG, but kind of this larger portfolio of drivers? These
it very well could be. I mean, we're at the end of the day, we're focused on the ability to repay the debt, but
right.
So to the extent there's other factors, other risk factors that are out there that need to be analyzed, or there are other sources of the revenue that are coming through based on the benefits that they're providing, trying to understand the credit worthiness or the credit strength of that particular revenue source for the benefit. Yeah.
I keep on saying, I think we're looking at two sides of a coin. Actually, there's three sides if you count the the band around the coin. But I think, Scott, I'm learning from all of this that if I got the revenue base, check mark. If there's anything potentially that could reduce or threaten the revenue base, then we better dang well find a way to minimize that risk.
Yep. Mitigate it. Yep.
If, by the way, in my mitigating that risk, I'm actually finding an additional revenue source that may actually be not just the 100% payback, but actually creating some additional benefit. So I kind of look at a question that was asked in the chat, and I want to play off of that. A lot of places that we're talking about where there are real challenges, Scott and Michael, are not in highly industrialized areas where the economics are at the best. Let me use an example. In one of the most repetitive impacted areas of Texas and Louisiana, what almost has become the new Hurricane Alley, not Tornado Alley, but Hurricane Alley, is literally in this area on both sides of the Texas-Louisiana border, okay? Oh, by the way, it also happens to have significant amount of chemical and petrochemical, understand the move to other energy sources, but it also is a big forest area. There's just a lot of industry, right? But this is a repetitively hit area, except, Scott, it is also an area that probably is rated in the B, all right? They cannot typically go to the market and raise enough revenue to become a part of the local match that's required for the Army Corps of Engineers, right? Or even come up with a certain amount of the public sector part of this, right? So I'm thinking, and I'm not sure if there's a solution right now on this call, but I'm thinking from both of y'all's perspectives that in areas where we are going to need to push in more resilience, more infrastructure to fortify, future-proof around some of these larger industry activities, they are in to some degree some of the poorest areas. And that to me is how we start looking at these multiple stacks of financing and what can be done to influence the ratings. Because I think, Scott, one of the issues is there's 300, 400 areas in this country that now are potentially going to be designated by new legislation that was introduced last week for designating resilient zones. And those resilient zones are going to be measured by most at risk and most in need. Okay. I'm curious how Fitch and other ratings and performance begin to take a look at these areas, most at risk and most in need, in a way that impacts the financing, the financeability of what needs to happen in some of these locations.
I mean, the way you're describing it, it could be something, Richard, that's not done as a standalone project financing without some type of, whether you call it a backstop from a creditworthy counterparty, or there's the whole concept of whether it's not a backstop but a deleveraging. So maybe the cash flows don't work if this is, let's just sort of say more and say it's 100% debt finance. The cash flows don't work to get it to investment grade level, or perhaps they work for a lower quantum of debt. And then you're going to need some type of, the way you describe it, you're going to need some type of support, whether it's direct credit support or there's some seed capital that's going in that makes whatever project ultimately financeable, because the debt level gearing works. But from the way you're describing it, you can't just do it in isolation.
Right.
There has to be more brought into the table.
Mike, thoughts on that?
No, I think that makes. I mean, I'm thinking about the situation in the U, and I'm thinking about Kirk Waltz's question in the chat basically too, and I'm also thinking about the situation you posited, Richard, say in Hurricane Alley, basically, where if the federal government came in and said, look, we realize that the risk to the nation's gasoline supply is bad enough, because if the refineries go out, and think of the economic catastrophe that would be nationwide. Therefore, we're going to provide a backstop, or we're going to come in and provide. I mean, that would certainly change the financial situation, basically. And Kirk, just to answer your question, yeah, the forest resilience bond could certainly apply to that. I mean, one of the ski areas got hit really hard in last year's South Tahoe fire and wasn't able to open this year. They're actually still in the middle of cutting down fire-killed trees that are basically hazards. If you're skiing, the tree could fall over at any minute and kill you, basically, and so forth. And so they're actually still having to clean up the resort, weren't able to open this year. That's catastrophic to the owner of the resort because they don't have any revenue, but it's also catastrophic to the community because of the loss of jobs. So I think that's a really great example of the need to basically model not only the project and what's going on with the project and the returns, but also model the impacts of it and the situation, and then be able to think creatively about how do we match them up essentially, and how do we address the need within the context, relative to what the project needs to be solvent and to have a strong financing model.
I want to leverage off of that and then recognize that we've got just about 10 more minutes. But I'm sensing in one of the parts of all of this investor forum that I think I shared with both of y'all is really to begin to have a call to action. And I think it really is where we can look at doing more pilots and demonstrations that build confidence. This idea of deleverage, de-risk, I think that's the reason why, Michael, you've heard me talk a lot about P4s, the private-philanthropic-public partnerships. And that includes certain places where insurance could step in an additional role here. But Scott, when we've talked about P3s or P4s in the past, this is where I'm looking at how governments can establish new types of credit markets, as Michael has talked about, these marketplaces that have not been fully developed in the United States. We're getting there, where government can provide incentives for the private sector to step in and maybe go beyond what is required of them from a rule or compliance perspective. I'll come back to that in a second. But also the role where philanthropy and social impact investing comes in. That has a little bit of a different return on investment model, Scott. Willing to take a little bit smaller return, or frankly, maybe no return, but for the impacts. And I am thinking about when Howard Buffett talked about this idea of impact returns on investment and rates of return, where taking a Fitch rating and a impact rate of return and almost bringing these two together, Scott, where you've got this traditional rating and ranking in this new look at impact, and bringing them together where they ultimately score out how this project is going to have this multiple impact, but also how it brings or attracts non-traditional capital to the table.
So from a ratings perspective, we wouldn't get into that type of
Right.
scoring. Presumably our rating would be used as an impact to it. One of the things that interests me about the concept that you give out is, just as we look for creditworthy counterparties, if it's an equity, a traditional equity sponsor, that that's some kind of a letter of credit that's posted for their piece of their commitment. I think we'd look similarly if it were to be some type of a philanthropic entity that was contributing towards it.
Right. And look, we're seeing, not to call them out all the time, but they are a major example. But the Nature Conservancy, through their venture fund, is stepping up, playing lots of roles. We saw it play out in the emergence of a pilot around the Chesapeake Bay, Scott, where they were looking at water quality and water quantity types of credits. All right. Why was it important for the Nature Conservancy? Because that's a part of their mission, is to see new ways that will impact the design of water conservation, water quality. But there was another little company at the table called Walmart, and another little company called Prudential, right? So Prudential came in with part of the project financing. Walmart came in because they had an abundant set of assets around the Chesapeake Bay, Scott, that were everything from large distribution centers to, their super centers, right? That's a piece of infrastructure that was contributing to the issues of water quality and water quantity that went from a negative to a positive, right? And that's where I'm thinking, how the significance, Scott, of what Fitch is doing today and where y'all are seeing the emergence of it, but also how this I'm not trying to make the complex even more complex, but the fact of the matter is that we now have, like I said, multiple resources and multiple types of investors, right? Okay, so my question to y'all before we begin to wrap up. I've listened to this session. I'm looking at two very brilliant people who teach me all the time. Now, what's my one takeaway, Scott? What's one action item as a result of where you see Fitch going and where it's impacting the marketplace? So tell me, if I'm a government official, if I'm an investor, if I'm a project financer, what's one good takeaway you'd like to have folks think about from this?
Yeah, I would think it's this whole instant thinking about resiliency, not just in the form of the asset itself, but what's going on around the asset. In terms of the example I gave, in terms of the toll road, it's getting hit with a 100-year storm every 5 years. You can have engineers build that to spec, but then it's fortifying that area to see what's going on there so that there is a business case of it. So when we look at resiliency, it's not just the individual asset itself, it's the the service market or the catchment area
Right.
from our perspective.
Yeah, it's the integration and, so to speak, whether it's the watershed or the shed, right? It's the larger piece. Michael, what's your one takeaway?
I think it's the need to survey the information capital and understand what is in that situation in terms of data capital that could be, evolved into actual knowledge capital. Because at the end of the day, these more sophisticated finance mechanisms or these collaborative finance mechanisms, they take the knowledge capital state, right? And so you have to be able to get the data, and there's a lot of new data sources coming, data technologies coming online, Internet of Things, field sensors, satellite imagery, basically, right? So all these things have to be brought to bear along with traditional information sources and integrated. And through that integration, you're creating that knowledge capital that can then be used in the financing structures. So that's my thought. Is being aware of what is there today and where it needs to go to be, to have it be kind of ready for these new structures.
Well, you've heard me say this, and I think Scott's heard me say this. We're drowning in data and thirsty for intelligence. And I think I think what you both have represented today is how do we actually start using significant amount of data for this type of intelligence, leading to better resource allocation, better, strategic approaches to this area of resilience. Let me thank both of y'all. And before you ring off, we've got 2 more left in the series of the dozen that we had planned. And actually this ties to this. One of our, we're trying to get it all tied down. We've had a few changes, few really great positive changes, but we've got a federal panel coming up with FEMA, Small Business Administration, Department of Homeland Security, the Economic Development Administration. We may be adding one more. But Scott, to our time in DC, these are 4 or 5 folks who are really leading in how federal resources are applied for these types of projects and investments. And I think this is informative and something I want to make sure they see. And then we're working with Natalie and the team at the Build Strong Coalition from an industry perspective of how the industry, not insurance, but industry who's impacted by a lot of what we're talking about will also be investing in these areas of resilience. So those are the next 2 coming up. And then hopefully by April, we'll be able to announce our return to in-person events that we're looking at doing in Boston, Houston, and a couple of other locations. And that, also influences how we begin to move forward on our next set of leveraging this investor forum from a series of events and sharing of knowledge to where we can actually drive some pilots, some demonstrations, some new investments. And so I want to thank both of y'all. We are recording this. It will be up on, the YouTube channel by this afternoon. And I can't think of 2 better friends and better teachers in what I've learned over the past several months and year about this opportunity to connect resilience and new forms of investing. So Scott, to you and to Mike, thank you so much for taking time today. Thank you for continuing to participate with all of the things that we're trying to do through the Resilience Innovation Hub, and look forward to continuing to collaborate and partner with both of y'all.
Thanks for the opportunity.
Thank you, Richard.
Yep.
Talk with you soon, and thank you all for participating and for listening in. Have a great day.
Take care.